Hello, everyone. Welcome to the Ashworth Wealth Weekly Market Update. My name is Todd McChesney. We'll kind of jump into this week's chart. This week's chart highlights the impact of high home prices, down payments, and mortgage rates on housing affordability. Homeownership remains a distant dream for many Americans, with a lack of affordable housing boxing many consumers out of the market. Some argue that the recent rise in mortgage rates is largely to blame. However, affordability issue doesn't stem from elevated mortgage rates of today, but from the artificially low mortgage rates of the last 20 years and the resulting rise in home prices. While elevated compared to last decade, mortgage rates today are not outrageously high. At 6.74%, current 30-year fixed rate mortgage rates are lower than they have been 60% of the time since 1971. At this rate, 31% of the median household annual pre-tax income would go towards mortgage payments. This is up from 19% in 1971, but down from over 54% in 1981. You can see that with the blue line there on the chart. Instead, higher home prices and consequently higher required down payments are the issue. In 1971, a 20% down payment on a single-family home consumed 57% of the median household annual income and around 80% for much of the 90s. However, excessive demand spurred by low interest rates after the dot-com bubble burst and the great financial crisis, along with the sluggish building activity, pushed home prices significantly higher. As a result, a 20% down payment on a single-family home now represents a whopping 100% of annual household income. I know many of us have children and grandchildren trying to get into homes, and this is the main issue. It's the down payment that they need because the price is so high, more so than the interest rates. And the interest rates are part of it. Lower interest rates could only address part of the housing affordability crisis, at least in the short run. While lower rates would mean smaller monthly mortgage payments for consumers, they also might pressure housing prices higher, making down payments even more difficult to afford. I don't really expect the Fed to cut rates this next week. We'll see what they do, but even if they do, an immediate bounce in the housing market is unlikely. So take a look at this chart and kind of see what's going on. For the most part, it's going to be a difficult road for the next little bit as we try to get through this housing situation. We really need wages to rise. We really need the housing prices to level off for our younger Americans to get into their first homes before they give up, obviously. So hopefully we can kind of get through this and get them to have that American dream of home ownership. As usual, feel free to forward this to any friends or family. We're happy to meet with any time. If you have any questions, reach out as well. We look forward to chatting with you soon, and we'll see you the next update. Thanks.